During his first term as president, Donald Trump made the decision to impose special taxes known as tariffs were imposed on a number of Chinese-made goods, essentially raising the cost of items like electronics, clothing, and other items. The primary goal of the tariffs was to support American companies. President Trump added these tariffs because he felt that China was not treating the West fairly in trade and was abusing the system, particularly when it came to stealing technology and ideas from American businesses. He wanted to raise the cost of Chinese goods so that more businesses and goods could be produced. Get the John cheaper now. President Trump has put forth a new plan to impose a 10% tariff on Chinese imports during his current term. This implies that if a toy made in China costs $10, an additional $1 will be added as a tariff, making the total cost $11. This concept is a component of his America First trade policy, which aims to lower the trade deficit by prioritizing American interests over those of other nations, which occurs when a nation purchases more goods from other nations than it sells to them by raising the cost of Chinese goods. Although not everyone agrees that these tariffs are a good idea, President Trump hoped that American companies would produce more goods and that consumers would purchase those instead of the more costly Chinese ones. He also believes that this would protect national security by reducing the U.S.'s reliance on China for essential goods. Some analysts claim that rather than actually lowering the deficit, President Trump's first-term tariffs increased costs for American families. For instance, if the cost of a Chinese-made phone increases due to tariffs that Americans must pay extra for it, this can make life more expensive for everyone. According to a group called the Tax Foundation, during Trump's first term, the Trump administration added nearly $80 billion in new taxes. They also stated that these tariffs could have a negative impact on the economy, predicting that the U.S. economy might contract by 0.2%, and that the tariffs could result in the loss of roughly 142,000 jobs. This implies that although the tariffs may benefit certain American companies, they may also have negative effects others and make many people's lives more difficult. While the U.S. was concentrating on tariffs, China was working on a completely new technology when it shocked the world by launching DeepSeek, a new type of AI developed by a Chinese company that began operations in 2023. The AI, called R1, is unique because it can perform many of the same tasks as the AI produced by large American firms like NVIDIA and OpenAI, but it's much less capable of producing what's DeepSeek discovered a way to make their AI function just as well using simpler and less expensive parts made in China. This is significant because it demonstrates that you don't always need the most expensive tools to create something amazing. It's like building a really cool toy using just a few simple blocks instead of a big expensive kit. What's really amazing about Deeps is that it was created with limited resources in the US. Companies like NVIDIA use very expensive and advanced computer parts called GPUs to build their AI. On January 27, 2025, Deep Search revealed its new AI, which sparked both excitement and concern. Something significant happened in the stock market. And then, the NASDAQ, a marketplace for buying and selling shares of technology companies, fell 3.1% in a single day. This was the largest decline the market had seen in more than a month. NVIDIA was one of the companies most severely affected. Its stock price fell 177%, meaning that many people lost a lot of money. In fact, the total amount lost was only $465 billion, the most money ever lost in a single day in the US stock market. This occurred as a result of concerns that deep search for new AI might reduce the value of NVIDIA's products. Importantly, the rise of DSEK has revealed that the US may not have the best strategy to prevent China from becoming a technological leader. The US attempted to slow down China's development by enacting export controls, which prohibited American businesses from selling China certain advanced tools and software, particularly high-tech computer chips and machines that we use to manufacture them. The idea was that without these tools, China wouldn't be able to build the newest technology. But China shocked everyone by coming up with new ways to innovate even in the absence of these tools. Chinese researchers developed unique AI applications that don't require the priciest, most sophisticated computers. Sections like the GPUs, created by AdVideo, which indicates that they managed to continue progressing despite US attempts to impede them. Another significant factor contributing to China's success is its emphasis on education and research. China has been sending its most talented students to study at the world's top universities, and many of them are now returning to China to work after gaining a great deal of knowledge. This phenomenon is known as reverse brain drain, whereby these gifted individuals return home to support China's development rather than remaining in other nations. Despite the United States, this has established a robust innovation culture in China. Attempting to use sanctions to impede China's advancement, China has continued to advance in fields like AI research and development, demonstrating that when a nation invests in its citizens and inspires them to think creatively, incredible things can be accomplished. When DeepSeek revealed its new AI technology, it not only shocked people but also significantly altered the stock market. Numerous large US tech firms, including Alphabet, which owns Google, and Microsoft Meta, which owns Facebook, saw their together. These businesses lost over $1 trillion in value investors, and those who buy and sell stocks began to worry that US tech companies were overspending on things like developing big data SS and purchasing pricey equipment. Deep SE demonstrated that you don't need to spend as much money to create something incredible, which caused investors to wonder if the US tech giants were acting appropriately. The S&P 500, a large list of companies that illustrates how the stock market as a whole feels. Also, the stock market has experienced a 1.5% decline. Tech companies, which make up a large portion of the S&P 500, were responsible for the majority of this decline. However, another significant list of companies did slightly better. In fact, it increased by 0.7% thanks to companies in sectors like consumer goods and healthcare. This indicates that while tech companies were having trouble, other sectors of the economy were doing well. But the main focus remained on how deeply Seek's success was upending the tech industry. People now have different ideas about how the US should handle trade and technology as a result of DeepSeek's success. The United States has long prioritized protectionism, which is the practice of attempting to safeguard American companies by imposing restrictions like export controls and tariffs. The goal was to prevent other nations, particularly China, from becoming overly powerful but deep sectoral. The story demonstrates that these policies may not be as effective as the US had hoped. Rather than slowing China down, they have actually encouraged its independence. China has increased its investment in its own R&D and is figuring out how to prosper without depending on the US. This suggests that rather than attempting to block, the US may need to modify its strategy. Other nations could put more of an emphasis on innovation and cooperation, which would entail investing more funds in research and education, as well as improving infrastructure like roads, internet networks, and labs. It also entails cooperating with other nations rather than attempting to travel. The emergence of deep search serves as a reminder that innovation can occur anywhere, even in the face of adversity. The US must be open to new ideas and think creatively, if it hopes to maintain its lead in the global economy. Although the history of the US-China trade relationship is complex, it offers some valuable insights. The United States attempted to slow down and safeguard its economy by implementing export controls and tariffs. Though these measures didn't go as planned, they encouraged China to become more innovative and self-reliant. This shows that even in the face of adversity, nations can find ways to succeed by investing in their citizens and thinking creatively. At the same time, the stock market's reaction serves as a reminder that the world is interconnected in many ways, and that events in one nation can have an impact on investors and businesses worldwide. The US must carefully consider its future trade and technological policies rather than it might be wiser to concentrate on developing a robust, innovative economy that can fairly compete on the global stage rather than attempting to block others. China's latest financial maneuvers have sent shockwaves through the global economy, particularly in the United States, where an astonishing $1 trillion has been wiped out from the market. This seismic shift in economic power is not just a momentary market fluctuation, but a calculated strategic move that underscores China's growing influence in global finance. While trade wars and economic tensions between the two superpowers have been ongoing for years, China's recent actions have taken an unprecedented toll on Wall Street. By leveraging its vast foreign reserves, reducing dependency on the US dollar, and strengthening alliances with emerging markets, China has altered the financial landscape in ways that Washington never anticipated. The repercussions of this economic maneuver will have a lasting impact on stock markets, international trade, and geopolitical relations between the two largest economies in the world. One of the key reasons behind this massive market turmoil is China's accelerated efforts to reduce reliance on the US financial system. Beijing has been strategically diversifying its foreign exchange reserves, shifting away from the US dollar, and promoting the use of the Chinese yuan in global trade settlements. By fostering stronger economic partnerships with countries like Russia, Saudi Arabia, and members of the BRICS alliance, China has been able to create an alternative financial ecosystem that challenges the dominance of the dollar. Furthermore, China's aggressive expansion in emerging markets has allowed it to establish trade agreements that bypass US-controlled financial institutions, diminishing America's ability to leverage economic sanctions and financial pressure on Beijing. This shift has directly impacted the US stock market, causing widespread sell-offs and a decline in investor confidence, particularly among firms with heavy exposure to international trade. Another crucial factor that contributed to the $1 trillion market wipeout is China's massive sell-off of US Treasury bonds. As the largest foreign holder of American debt, China has long used US Treasuries as a means of economic leverage. However, in recent months, Beijing has significantly reduced its holdings, triggering panic among investors and increasing borrowing costs for the U.S. government. This move has further weakened the U.S. dollar and led to heightened concerns over America's ability to manage its growing national debt. The Federal Reserve, already struggling with inflation and interest rate adjustments, now faces an even more challenging economic environment. With China actively shifting its capital to gold, digital currencies, and other assets, the U.S. financial system is experiencing a liquidity crunch that has only exacerbated market volatility. The repercussions of China's economic maneuvers extend far beyond Wall Street. The sudden market downturn has led to a cascading effect across various sectors, from technology and finance to manufacturing and consumer goods. Major American corporations with significant business ties to China have reported declining revenues and supply chain disruptions. Companies like Apple, Tesla, and major semiconductor firms have been particularly hard hit, as China's shift towards self-reliance in key industries weakens their market share. Moreover, with China developing its own semiconductor industry and reducing its dependence on American technology, U.S. firms that once dominated the global tech landscape are facing an existential crisis. As China strengthens its domestic production and enhances its technological capabilities, the U.S. is struggling to maintain its competitive edge, further exacerbating the economic downturn. Looking ahead, the U.S. must reconsider its economic policies and adapt to this new global reality. The era of unchallenged American financial dominance is rapidly coming to an end, and Washington needs to formulate strategic countermeasures to regain stability. This could include diversifying trade partnerships, reinforcing domestic manufacturing, and reducing reliance on foreign debt holders like China. Additionally, fostering innovation in key industries such as artificial intelligence, green energy, and semiconductor manufacturing will be critical in maintaining long-term economic resilience. However, one thing is clear. China's recent actions have fundamentally reshaped the global financial order, and the U.S. must navigate this shifting landscape with caution and strategic foresight. The coming years will determine whether the U.S. can adapt to this new reality or continue to experience the fallout of China's economic masterstroke. China's calculated economic moves against the United States have not only triggered immediate financial losses, but have also set the stage for long-term global economic realignment. The $1 trillion market wipeout was not a mere coincidence. It was the result of years of strategic planning by Beijing to challenge American economic dominance. This shift is particularly evident in China's increased reliance on the yuan for global trade, which has seen a rapid rise in international transactions. Major oil-producing nations, such as Saudi Arabia and Russia, have begun accepting yuan for energy deals, reducing their dependency on the US dollar. This de-dollarization effort weakens the US's ability to impose economic sanctions and maintain its influence over global trade. As more countries look toward China as a stable economic partner, the US is left scrambling to maintain its foothold in key markets. With central banks around the world reducing their holdings of US dollars and increasing reserves in gold and alternative currencies, America's traditional financial influence is under unprecedented threat. The fallout from China's financial assault extends beyond just stock market losses. It has also created a ripple effect throughout the global investment landscape. The shift in economic power has led to a decline in foreign investment in U.S. markets, as investors look to hedge their risks by diversifying into Asian and emerging markets. Hedge funds and institutional investors, once heavily reliant on the predictability of the U.S. financial system, are now exploring opportunities in China's rapidly expanding economy. The increasing attractiveness of China's capital markets, coupled with its government-backed technological advancements, has given investors new options outside of the U.S. Beijing has also introduced policies that make investing in China more appealing, such as relaxing restrictions on foreign investment and expanding its Belt and Road Initiative, BRI, to create new economic alliances. This growing investor confidence in China stands in stark contrast to the uncertainty surrounding U.S. economic policies, exacerbated by high inflation, rising interest rates, and political instability. One of the most alarming aspects of China's economic strategy is its impact on the U.S. Treasury bond market. By offloading large portions of its U.S. debt holdings, China has increased borrowing costs for the U.S. government, which is already struggling with a soaring national debt. Higher interest rates on Treasury bonds mean that the U.S. must pay more to service its debt, putting immense pressure on an already fragile fiscal system. This could lead to severe consequences, including budget cuts in critical areas such as infrastructure, defense, and social programs. The U.S. Federal Reserve, already in a tight spot due to inflation concerns, now faces a dilemma. Should it continue raising interest rates to combat inflation, or should it pivot to prevent further economic instability? Either decision carries significant risks, and China's actions have effectively forced Washington into a no-win situation. If China continues its bond sell-off strategy, the U.S. could be pushed into an economic downturn, further weakening its global standing. Beyond financial markets, China's actions have also disrupted U.S. supply chains, creating additional economic turmoil. The COVID-19 pandemic exposed the vulnerabilities of America's dependence on Chinese manufacturing, but instead of taking corrective measures, many U.S. companies remained reliant on cheap Chinese labor and production. Now, China is leveraging this dependency by tightening its grip on critical supply chains, particularly in the technology and rare earth minerals sectors. These resources are essential for producing semiconductors, electric vehicles, and military equipment, meaning the U.S. is now at a disadvantage in key industries. Beijing's push toward technological self-sufficiency has further exacerbated this challenge, as China continues to invest in its domestic semiconductor industry to reduce reliance on American technology. If China imposes restrictions on exports of these critical materials, U.S. industries could face severe production slowdowns, further weakening their global competitiveness. Looking ahead, the U.S. must fundamentally rethink its economic strategy to counter China's growing influence. Relying on traditional financial tools such as sanctions and tariffs may no longer be effective, as China has built alternative trade networks that reduce its exposure to American economic pressure. The U.S. must invest heavily in domestic manufacturing, secure alternative supply chains, and develop stronger alliances with nations that share its economic vision. Additionally, innovation in key sectors such as artificial intelligence, clean energy, and defense technology will be crucial in maintaining an edge over China. The world is witnessing a historic shift in economic power, and the U.S. faces a critical inflection point. If Washington fails to adapt to these changes, it risks losing its position as the world's leading economic force. China has proven that it can challenge U.S. financial dominance in ways previously thought impossible, and what comes next will determine the balance of power for decades to come. China's strategic economic maneuvers have placed the United States in an increasingly vulnerable position, forcing American policymakers and businesses to reassess their long-term financial strategies. The $1 trillion wipeout from the U.S. market is not just a reflection of immediate investor panic, but a sign of deeper structural shifts in the global economy. China has systematically worked to reduce its dependence on U.S. financial institutions, strengthen its domestic markets, and build alternative trade and investment partnerships. As Beijing continues to consolidate its economic influence, Washington faces a significant challenge: how to respond to a rival that is no longer merely competing within the existing global system, but actively working to reshape it. The question now is whether the U.S. can reclaim its financial dominance, or if it will continue to cede ground to a rising China that is capitalizing on America's economic vulnerabilities. One of the most concerning aspects of China's economic strategy is its impact on American technological and industrial dominance. China has aggressively pursued advancements in artificial intelligence, quantum computing, and semiconductor manufacturing, industries where the U.S. once held an uncontested lead. By investing heavily in research and development, as well as forging strategic partnerships with other technologically advanced nations, China has positioned itself as a formidable competitor in the global tech race. The recent market losses in the U.S. have only intensified concerns over the country's ability to maintain its leadership in innovation. Major U.S. tech companies, such as Apple, Intel, and Nvidia, have suffered significant losses due to China's increasing self-sufficiency and growing hostility toward foreign firms. If China continues to advance in these key industries, while the U.S. struggles with supply chain disruptions, regulatory challenges, and declining global influence, the balance of power in the technology sector could shift dramatically in Beijing's favor. Adding to this economic pressure is China's success in expanding its influence through global financial institutions and alternative economic alliances. The formation of the BRICS economic bloc, comprising Brazil, Russia, India, China, and South Africa, has provided Beijing with a powerful platform to challenge U.S.-led financial systems such as the International Monetary Fund, IMF, and the World Bank. By encouraging trade among BRICS nations in local currencies and reducing dependence on the U.S. dollar, China has weakened America's ability to exert economic control through financial leverage. In addition, China's Belt and Road Initiative, BRI, has solidified its relationships with dozens of countries across Africa, Asia, and Europe, creating a global economic network that operates largely outside of U.S. influence. As more nations align themselves with China's economic vision, Washington risks being sidelined in international trade and investment, further exacerbating its market instability. Meanwhile, The impact of China's financial strategy is not just felt in stock markets and investment portfolios, it is also directly affecting the everyday lives of Americans. Rising inflation, higher borrowing costs, and economic uncertainty are byproducts of China's strategic withdrawal from U.S. financial markets. As the Federal Reserve struggles to stabilize the economy, average Americans are bearing the brunt of these shifts through higher mortgage rates, increased credit card debt, and a volatile job market. Many companies, faced with declining investor confidence and a weakening economic outlook, have already begun implementing hiring freezes, layoffs, and budget cuts. The erosion of American economic stability is not just a short-term concern, but a long-term challenge that could reshape the standard of living for millions of people. If the U.S. government fails to address these vulnerabilities, economic hardship could become a persistent reality for future generations. The road ahead for the U.S. is filled with difficult choices, as policymakers must navigate an economic landscape that is increasingly shaped by China's strategic moves. Rebuilding trust in the American financial system, reinforcing domestic industries, and strengthening alliances with key global partners will be crucial in countering Beijing's economic rise. Additionally, Washington must take a proactive approach to technological innovation, ensuring that the U.S. remains a leader in critical industries, rather than falling behind in the race for global economic dominance. The $1 trillion market loss is not just a warning, it is a wake-up call. If the U.S. does not adapt to the new realities of global finance, it risks losing not only its economic leadership, but also its ability to shape the future of the world. Economy. What comes next will determine whether America can regain its footing, or if China's financial revolution is only just beginning.